Welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions this evening are Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. If you'd like to send questions, please email stockwatch@bdtv.co.za or via SMS on 41392. Jean Pierre, Ricus, good to see you both there this evening. Ricus, if I may start with you, it was a slightly weird day on the JSE today in that it ended negative, but there were some reversals in quite a few shares during the day, I noticed. For example, shares like Thungela were up quite significantly, and then that kind of whittled away to the close. So where we finished wasn't seemingly an indication of where we started today, but topsy-turvy.
Yeah, I just got the impression that we sort of started softer and then just went softer as the day continued. I just had a brief glance at the top 40, and there really wasn't a lot of green on that screen. I mean, things like Thungela, I think, went down quite markedly yesterday, and maybe just recovered some of that. Yeah, momentum I just got the flavor that we were just being sold off again. I don't know about you, Jean Pierre.
I mean, Jean Pierre, from one day to the next, it feels like we take one step forward and one step back. You know, it's almost impossible to discern any sort of trend.
True. And it's even equally impossible to try and forecast what tomorrow will bring.
Yes,
and that
indeed.
is why I might sound like a broken record, but when it comes to the daily moves, I know that I don't know. It is so random. I'll pick one little example. So last night, we finally, after many years, had the Bank of Japan raise rates in Japan, and they said they're going to stop buying the ETFs on the Japanese market. And everyone who's anyone said, finally, after the end of all these years, Japan's interest rates are going to normalize. And that is going to mean Japan is going to bring back cash from overseas, all these Japanese central bankers and corporates. And the yen is going to strengthen sharply when that happens. Julieta, do you know what happened overnight? The yen weakened. So these daily moves, sometimes the exact opposite happens to what even most people expect. And I am constantly surprised by daily share price and other asset movements.
Yeah. Yes, Mrs. Watanabe, the paragon of the Japanese markets, is a tricky beast to figure out. Before I get to questions, can I ask you both about, I'll come back to you, Jean Pierre, but Ricus, I mean, it's viewed as a massive and historic moment in Japan, and with a caveat that going from negative interest rates, they've gone to zero or to minus or plus 1.1%. So it's not exactly a massive move, but is it symbolically a huge shift for the Japanese stock market, which only recently managed to, I suppose, retain its highs that it hit 30 years ago?
Yeah, as you said, 0.1. Goodness knows where that will stop. 0.5. They might be losing their heads. But I do agree that well, if you trust the Bank of Japan, it is a sea change. I mean, they've had this going for what, 8 years, if I'm not mistaken. So Bank of Japan is pretty confident that their deflationary period is over. Obviously, time will tell. The rate at which it hopefully gets better, that's also under discussion. But certainly as far as wage demand is concerned, they've had a hectic increase for their biggest union, about 5.5%. Obviously, the Bank of Japan is confident that the quagmire that the Japanese economy has been subject to for a very, very long time might be turning, and that will, in the long run, influence the way the market views Japan, both as far as their money market's concerned, and obviously also their equities. But it's not going to be an instantaneous thing, as JP just said. The yen is probably still weakening. I mean, nothing is certain, nothing turns on a dime. But yeah, I think the outlook possibly have flipped side, if I can put it that way.
Yeah. Jean-Pierre, there have been a couple of funds, and I think there's some South African funds that took a bet on the Japanese markets, and they've done very well as a result, which maybe was a bit of a surprising call. Do you think that there is more to be had from some Japanese or Japanese equities generally?
So we've looked at the Japanese market in quite a bit of detail the last few years, and it's important to realize that similarly to South Africa, you can broadly split the market into two different types of companies. The one is domestically focused Japanese companies, and the other one is exporters, where they're exporters of goods or services. And the dynamics have been quite different. So the yen has weakened a lot over the last few years. So that has really boosted the exporters when you look at their earnings in yen, and the earnings of the companies that are more domestically focused seem to have held up in yen. But when you then translate that to the currency in which you invested, if you're a US dollar investor, for instance, you would have lost money on a Japanese yen stock, which actually stayed flat because the yen weakened against the dollar. Now, as rand investors, it's a bit different because the rand has weakened even more than the Japanese yen has weakened. But in relative terms, one can say that both currencies have weakened. So don't think necessarily you've done well if you've had a return in rands after investing in companies denominated in yen. The real winners have been those exporters because they actually, even though the companies are denominated in yen, earn in dollars, and by exporting, they made more yen because the yen weakened. We still have some holdings in Japan. We think the semiconductor industry is interesting. And a few of these domestically focused companies are also interesting because in dollar terms, their prices have actually come down the last 2 to 3 years. So yes, I do think there's more to come, but it's important to differentiate between the exporters and the more domestically focused Japanese stocks.
Okay. Moving on to questions, and maybe we'll meander back to Japan. But Remgro came out with results today, and the question actually isn't on Remgro, but it's on a couple of other investment holding companies, Ethos Capital and ARK Invest. And the viewer wants to know, does he hold or sell those two shares? Ricus, starting with you.
Ethos and ARK, is that African Rainbow?
African Rainbow Capital.
Yeah, well, for starters, investment holding companies are not the flavor of the month. Remgro's results sort of underpinned that feeling. I don't have an interest in either one of those two. Obviously, ARK very dependent on what you value Rain at, which seems quite pricey. Ethos, obviously, I think Bright is your problem there. So even if they are hugely at huge discount at whatever net asset value you want to use, I think there are far better opportunities in individual companies rather than being stuck in an investment holding company. You might as well then just be stuck in an ETF of some sort. It's the same principle.
Jean Pierre, are you similarly dour about those shares? I mean, Ricus talks about not being the flavor of the month. I feel like they haven't been the flavor of the decade. They've traded at these massive discounts to net asset value for a very long time now. Gone are the days when Bright was a premium to net asset value, for example.
Indeed. So the two drivers of investment holding companies, firstly, the underlying assets, what's in the portfolio, and then secondly, your return could be magnified or retarded by buying the shares at a discount or a premium to that net asset value. In the case of the two companies mentioned, Remgro's got the better track record, or the three mentioned, the better track record in terms of long-term value creation. Ethos, as Ricus has said, had the Bright assets, which are still struggling and have underperformed of late. And then ARK, the issue there is, for some reason, the management team focuses on net asset value and not net asset value per share. And that leads them to do rights issues which might enhance the net asset value, but destroys the net asset value per share. And when we buy shares, we buy them on a per share basis. So what is good for the management team on a net asset basis is not good for a shareholder on a net asset value per share basis. So there's a mismatch in incentives, which I don't like. I'll throw one more in the mix. Another investment holding company that reported today, Sabvest. Sabvest has got a very good long-term track record. It's generated double-digit returns over the long term. It is trading at a significant discount to NAV, and you cannot buy the underlying investments directly. They've got a little bit of Metrofile and transaction capital, but if I ignore that. So I would put that one in the mix as well, and I would prefer Sabvest, liquidity allowing, rather than African Rainbow Capital or Ethos.
Okay. I mean, is there a point to buying investment holding companies, in your view? And Ricus, I'll go to you, and then Jean Pierre, I'll go back to you. Companies that you can't access the assets any other way but these listed vehicles in the JSE.
Jean Pierre was talking about Subwest, and that's precisely the point you are making as well. The Subwest, which has got a number of very interesting, very stable, very interesting companies in that portfolio where you can't get it anywhere else. There's the case to be made, because even if it remains at a discount to net asset value, it doesn't really matter, because you are partaking in the underlying growth of the investments, and it's either going to be a return of capital to shareholders. Sadly, it's not really, because their dividend policy is not exciting at all, or otherwise the growth in those assets being sold off, being spun out.
Okay. Jean Pierre, maybe one last word there on. Okay, so you like Subwest. I mean, is there a reason that you would buy Remgro? Because Remgro seems to be a bit disastrous. You know, all the write-offs that it's taken, for example, in the Distel assets, Heineken assets.
Correct. So like I said, it depends on the underlying assets. So with those write-downs, the NAV is depressed, but from this depressed base, one could argue that maybe the growth outlook is actually better now that the base is depressed. And then you add in the fact that you can buy it at a discount, and you add in the fact that you cannot buy the Heineken SA and Mediclinic businesses directly any longer. So it depends on the long-term track record and performance of the underlying assets. And finally, you want a management team that is incentivized to unlock the discount if it gets too big. That's, as an example, what happened at PSG. They unlocked the discount and shareholders got significant value from that unlock. I don't know if the Rupert family really wants to unlock the Remgro discount, and if not, then that discount can persist and can get much wider than you would expect.
Yeah. Okay. What is the view on Bytes Technology from medium to long-term buy? The trade updates look good, dividends paid twice a year. There is weakness in the share price of late, driven by the actions of the previous CEO, but it should subside with time. And is it a good buy with the current weaker share price?
Normally, if a governance issue like this raises its head, it's a red flag to me, and I would say get out. But the actions of, or the pattern of trading is so strange. I mean, I cannot see the sense of it. So I am hesitant to say this is not the apple that's going to spoil the rest of the batch. And then looking at the company fundamentally, I think it's at least one of the few ways that a South African local investor can get a foothold into technology, apart from Naspers and Datatec, for example. So I'm fine with the company. I'm fine with their performance. I also think if your CEO spent most of his day trading stock, and the company is doing so well, imagine what it can do with somebody that actually concentrates on the business.
Yeah.
No, it is just completely strange. So normally I would say, gosh, don't like this, avoid. But in this case, it's, the circumstances is so strange, and the company itself seems okay. So I think possibly it's a buy at these levels.
I mean, Jean Pierre, we were wondering aloud whether the CEO had a possible gambling addiction. Of course, we are saying this without wanting to incur any sort of libel suit, and it is just a supposition. But do you concur with Jean Pierre and with Ricus that the company itself is fundamentally sound, and the fact that the board has taken, the action against the CEO and said, okay, out you go, that you would have some faith in the remaining management at the company?
Yes, exactly. And look, great results that they've delivered for a few years in a row, even though it was only unbundled recently out of Altron. This is a business with a very long history, actually, of delivering IT services in the UK, and particularly Microsoft-related services. And that is such an exciting area right now, especially with Copilot. So a lot of big organizations with licenses to use Microsoft across their organization will potentially decide to add on Copilot. And the way that Microsoft is going, I don't know who else has seen this, but we use Microsoft in our organization as well. These days, there's not just one license. You pay for Office, and then there's this add-on and that add-on and that add-on, and before you know it, you're writing big checks to Microsoft. So it's a bit irritating, but it shows the big competitive advantage that Microsoft has, how deeply ingrained they're in most businesses. That's why it's one of the biggest companies in the world, and that's why I do believe that if you are associated with that growth by being a service provider, an intermediary to offer the Microsoft service like Bytes does in the UK, you're well positioned. So I also think that this is not going to upset this apple cart.
And just lastly, from both of you, are you fairly confident in Bytes' exposure to the UK market, to the UK economy? It's not, it's not shooting the lights out by any stretch of the imagination. Jean Pierre, do you think it's,
Look,
are you happy to be invested there?
Yeah, if I could wave a wand and they would rather be in different geographies, I would probably choose a different one, like the US, for instance. But it's not too bad. Still, again, as a South African investor investing in rands, even though your pound profits might not grow at a very high rate, if it just grows at a decent rate and you translate that back into rands and the rand weakens against the pound over the long term, you're going to get a very nice rand return.
Ricus, similarly, are you happy to have exposure to the UK?
Yes, small cap analyst Keith McLaughlin said something interesting when we had this Microsoft outage a few days ago, where people just said, "Oh well, we can't use Teams, we can't use whatever. We might as well go home." Microsoft is a utility. It's not a high flying. You can't go without it, even if you are in the UK, which is by no means a high growth economy, but it's a heck of a lot better being in a lot of other things. And I agree with Jean Pierre. Even if it isn't pound, even if it's not a great economy, you're still going to get decent returns.
Okay. All right. Talking about shares offering decent returns, a question has come in asking you both to pick 3 shares for stable, increasing dividend income for orphans, widows, and pensioners. Jean Pierre, are there any 3 sort of bulletproof stocks that spring to mind instantly?
So I'll give 3, but there is no such thing as a bulletproof stock, Julieta. The future is always inherently uncertain, and even the best companies need to fight against their competitors every single day. So I would say you can probably have 1 retailer in there. Let's choose Clicks. You can choose either Clicks or ShopRite. I'll go for Clicks. I think one of the best business models around for widows and orphans is short-term insurance. So you could have either Santam or Outsurance. So that's already actually 4 between Clicks, ShopRite, Santam, and Outsurance. I'll stop it there.
Okay. Can I just ask you, why is short-term insurance? Why short-term insurance that much better for widows, orphans, and pensioners than, say, life insurance?
A well-managed short-term insurer is one of the best business models out there because you are getting paid for your liabilities and you can invest that into other securities, whether money market securities or the market. So any company with negative liabilities where you get paid on your liabilities is a good business model.
Okay. Ricus, anything to add into the mix there?
Okay, that's local. I'll go offshore. And one is my stock pick tonight. The other one, Caterpillar. The other one, Procter & Gamble. These guys have got decades of growth in dividends. And you can't go wrong with that. Sometimes they might be a little bit pricey, or sometimes they might be very cheap. But with a track record like that, you're bound to make money over the long term.
Okay. I'm sorry to have preempted your stock pick. So let me go to a question that a viewer sent asking, I suppose, for a novice investor. He said, could you please ask the panel, what are share buybacks and how does it add value to any company? I'm just starting to invest in the markets. Ricus, sticking with you. Why share buybacks over dividends, for example?
Because there's this thought, and Rabbi might disagree with me, that a company has got money. It looks at its share price and says, wow, this share price is hugely undervalued, rather than going and use that money to actually do what the company does, whether it's manufacturing widgets or or lending money to people. Let's go and buy our own shares, which will reduce the number of shares in issue. And then when you do a yearly statement, voila, you've got an increase in earnings. My point is, if you don't know what to do with your money, give it to me and I'll go and buy your share if it's undervalued, or otherwise I'll go and invest somewhere else.
Okay. There was another school of thought saying, perhaps this is the best potential investment for a company. If their shares are a screaming buy, let us rather buy them because it shows faith in the company. So I'll ask Jean Pierre what he makes of that, or if he has a similarly jaundiced view about share buybacks to Ricus.
So I agree with what Ricus said. I prefer getting the money back, and I can decide if I want to buy back that company shares. But I also have the choice to buy other company shares. While a company that considers a buyback doesn't consider buying other shares, it only considers buying its own shares. So there I agree with Ricus. The one difference potentially is tax. If you have a bunch of individual shareholders, or these days in South Africa, foreign shareholders, there could be reasons why you do a buyback rather than paying a dividend. From the perspective of an individual shareholder, you would pay dividend withholding tax, while from a share buyback, you would benefit from the fact that if you see a company as a cake and there is 1,000 shares outstanding and they buy back 10 of their shares, you don't own, if you own one share, 1 out of 1,000, you now own 1 out of 900. So your percentage shareholding in the company has gone up. You own a bigger share of the company. That is positive. And the company's earnings per share gets a boost as well, because the earnings aren't divided by 1,000, it's divided by 900. So there's a lot of reasons why share buybacks could add value if they are bought at a cheap price, but I prefer the dividends, so I can choose that company shares or any other company shares.
Okay. Thank you, gentlemen. So you have a little bit more time to expand on your stock picks this evening. And Ricus, I'm not sure if we have now jumped the gun. You mentioned Procter & Gamble and Caterpillar. And I couldn't actually tell if Procter & Gamble was your stock pick or if it was Caterpillar.
No, it was the third one. It's called Illinois Toolworks.
Oh, there we go.
First of all, they're a hugely American company, usually don't diversify. They do auto parts, they do welding machines, they do food services machines, they do electronic metering equipment. So you can see where it's based. It's based on the bedrock of American industry. As far as the American economy is concerned, we've got a sturdy economic growth and lowering rates. I mean, I don't think you can get a better economic environment. So as far as the domestic, shall we say, manufacturing sector in America is concerned, that's been left behind by all the hula about NVIDIA and all the tech shares. I think there will probably be a shift in investors' money towards that kind of company, that kind of industry. And Illinois Toolworks, very well based on that. As I've said, they've have a constant record of dividend increases that spans, I think, almost 50 years. So they know what they're doing. And technically, graph looks right.
Yeah, and they've actually had a really good run. Well, certainly since October and even over a one-year period. Okay, so Illinois Toolworks, that is probably pretty left field, but thank you for Ricus. Jean Pierre, what takes your fancy?
I am choosing multi-choice tonight. And the reason I'm choosing multi-choice is not necessarily taking a long-term view about video entertainment and what might happen to Showmax and what's going to happen to their betting business and the rollout of online television on your cell phone on the African continent. And those are all very nice, but it's because of the special situation of the offer from Canal Plus that is expected going to be made at 125 Rand a share in the next few weeks. That is the expectation. Now, the interesting thing here is Canal Plus is in a little bit of a corner, in my opinion. They have to make an offer based on what the takeover regulation panel has ruled, but they need the offer to be successful. There's a risk that they make the offer, they don't get enough acceptances to take them over 50% or whatever number they want, maybe even to take out the whole of MultiChoice Group, and then do the corporate action to make sure they solve for the foreign shareholding at MultiChoice South Africa, the subsidiary. So they need to make this work. And the MultiChoice group board obviously knows this. Yeah. So 125 might not be the final offer. And Canal Plus cannot risk the offer leading them not to take over the whole of MultiChoice Group, because then for a whole year, they're not allowed to do anything. They're in limbo, and they might need to then force sell the indirect stake in MultiChoice South Africa. So given all these permutations, I think your downside is relatively capped if you buy below 110 Rand.
Okay.
Your upside is at least 125 Rand. Maybe it takes a year to 18 months for that deal to happen. Plus, you could have another bonus if they do increase the offer, which I think is a distinct possibility.
Yeah, a very interesting game of chess playing itself out in that particular deal. Jean Pierre, Ricus, it's great to chat to you. As always, thank you very much for joining us this evening. Jean Pierre Verster is from Protea Capital Management. Ricus is from PSG Hole-in-One Ruimsig, and we will be back with the close up next. Stay with us.